Welcome to this week's Nebraska Soybean Board Weekly Market Roundup, brought to you by Nebraska soybean farmers and their checkoff. Joining us on the program today, we've got Ross Baldwin from agmarket.net. And Ross, as we kind of kick things off today, the cattle markets, they just continue to be on fire, but a little bit down this week. But even though we've been a little down as we close out the week, that's the first time in a long time, isn't it?
Hey, Steve. Yes, this is the first time in several weeks. It's actually be the first lower weekly close that live cattle have had in the last 8 weeks. And over in the feeder cattle contract, it's been about the same, 6 to 7 weeks since feeders have closed lower on the week. So the market is still at record high levels and on fire. But yeah, we are finally taking a little bit of a breather, it feels like, which most of us have been wondering, at what point is this market due for a correction?
Well, very good. We will get more of Ross's thoughts after this commercial message from the Nebraska Soybean Board.
It may be small, but this little bean fuels a lot of power. It powers a food industry as a top source of protein. It's a fuel that powers diesel engines with fewer emissions. It powers a state economy and bottom lines. And it powers the rest of the world as a top Nebraska export. Yeah, it may be small, but we're finding more ways for this little bean to power Nebraska.
Welcome back to the weekly market roundup, brought to you by Nebraska soybean farmers and their checkoff. Ross Baldwin of agmarket.net is joining us today. And as we're talking about these numbers there, Ross, it's just as we said, cattle numbers just continue to be so strong, even as we close a little bit softer, closing out the week here. It's been so long, and we keep having to ask ourselves, how long will this trend continue?
Exactly. On the week right now, we're down $3 to $4 across live cattle. The feeder cattle market anywhere from $5 to $7 lower on the week. So when you step back, this market's been higher the last 6 to 8 weeks on a weekly basis, and we all know markets can't go higher forever and they're due for a correction. But when you step back and look at the big picture, you got to remember that it was just at the end of June, the first part of July, that you had live cattle prices at $2.10 on the board. The feeder cattle market was down around $3. It was last week that September feeders made a high of $3.70, and this live cattle market's got up near $2.45 here recently. So we've had across live cattle a $30 to $35 rally in a couple months time, and feeders they pushed a $60 to $70 rally. So I mean, it's a small correction, but there is some interesting technical indicators that we are closing below that have been some major trend line support here recently. You look at October live cattle, their trend support comes in at 238.50. Right now we're at 235.70. This trend support started at the beginning of July when this massive rally started. So we are approaching some major support levels to where you could start to see maybe a more meaningful correction here as we do move forward.
Very interesting times. Doug Simon from Tredas is joining us as well this week. Doug, how are you doing?
Good afternoon. I'm doing well.
Well, good. Hey, Doug, as we're taking a look at things, yeah, we got you loud and clear. As we're taking a look at things this week, what's jumping out to you in the grains as we close out another week here?
Well, they're actually moving higher today, which is nice. We had nice move, earlier in the week. So we had a couple days where they, one day up, next day's down, but finishing up. I mean, we're up in that hit 424 today. So we were down 391 in the D's, a couple weeks ago. So we've had 33-cent rally. So we were at relative strength in the corn market. The bean market's more in the middle. We had less. We haven't had any confirmation that exports going into China, so everybody's really worried about the level of exports there. And I'd say that's true on both the corn and the bean side. USDA's got a big projection on the crop. They've got a big export projection on both the corn and the beans. And so, those balance sheets are. I think people are trying to figure out. We had 188 yield up there with. Stone X a while back, and USDA's yield. I think now there's maybe some seller's remorse on some of that. So we've had a nice little rally in the September and the D's corn. For example, today September's up a lot stronger than the D's, and as we go into deliveries, we haven't had a lot of deliveries on the corn or the beans. So that's interesting to see right now.
Yeah, Doug, you mentioned kind of the thing we're all watching. China. Will China get into this market and buy some soybeans? And at least as of this point, we still just haven't seen that, have we?
We haven't seen it, and looking at export values and after freight, the U.S. is actually, I think, competitive on the soybean side, but they're paying more to bring in Brazilian beans just largely because they want to have, you know, a kind of some leverage going into trade negotiations. There's talk that Trump and Xi will get together at some point here, but we're just not seeing that. Now, the other contrast to that is that we're exporting beans to other places that don't typically buy beans from us. So we do have a lot of beans on the book, but if we miss out on what's going into China, that's going to be pretty devastating. And the fact that we're already into this time frame and they're getting beans bought for October and November, which is usually a pretty good slot for us, that's definitely hurting our soybean basis at the rail loaders that are here. The last several years, we've seen strong rail basis in western Nebraska, kind of central Nebraska, where they were, you know, shipping beans to the PNW into Mexico. Those basis levels this year are more out in the 70 under range, where last year they were somewhat competitive with the new processor up in Norfolk and Lincoln and Fremont on the soybean side. And now there's a 35-cent gap between those processors and the rail loaders just because there's no business going to China right now.
Yeah. Ross, I heard Mexico mentioned there that we continued on the cattle side to be dealing with this New World screwworm issue. How is that influencing the markets right now in terms of what that's done to the movement of cattle, imports, exports, all of it?
It continues to have a major influence on the cattle markets. As of right now, there's no indication of if or when that border is going to reopen right now. The USDA came out, it's been a few weeks ago that they made some major announcements and infrastructure investments on sterile fly production, but you're a long ways down the road before these sterile fly factories are getting ramped up and getting to the production that they feel is needed. So we continue to deal with that. I mean, it's been the largest driver of this feeder cattle market recently on the strength that we're seeing. And, you know, it's crazy because it just coincides with the tight numbers that we already had here in the US. So, I mean, it looks like we're gonna end the year at this rate with over 1 million less head of feeder cattle. We typically import, say, 1.3 to 1.5 million head of feeders from Mexico every year, and year to date's a little over 200,000 head right now. So it's having a significant impact on the markets as a whole, and it's really starting to show up in the South down in Texas right now, and we're actually starting to see, as cash trades got a little heavier feeling up here in the North, we're seeing the South start to trade the same levels that the North has been trading. And it's been a long time since we've seen the South trade at the same levels as the North. And it's my opinion that we're going to see the South start to go premium to the North. And the large driver is that the border being closed.
Yeah, very interesting. Something I want to ask both of you about, just some of the other economic factors we're looking at right now. Certainly, we have the ongoing issues around trade and tariffs. We've also got a jobs report just out. What does that do? Well, we've also got the value of the dollar. There's all these other factors we're taking a look at. Doug, do you see any movement from any of that having any influence? We'll start with you, Doug, on the grain side. Any of those things?
The weaker dollar helps our exports, makes us a little more competitive that way. You know, but jobs report, I didn't really pay attention to that day. Again, looking at the corn market and just looking at like livestock as well. Is it what the high prices that we have on the cattle? What do we do in terms of, you know, people have hedged a lot of feeders, but also starting to look at, you know, for unborn, you know, looking into next year, you know, so we can try to keep protecting these higher levels. It's almost like $8 or $8.50 corn. You want to make sure you're still looking at that. And the other thing we've been spending a lot of time on is making sure you understand the government programs from the One Big Beautiful Bill. They really boosted up the levels on the ARC and the PLC, and they'll play the higher of those two when we get out to the end of the year. But you essentially got to put underneath your soybeans at around $11 when you look at the cash price of it, and also about $4.60 on the corn. So we've been looking at that free put essentially on looking at what percentage of the farmers' crop that they produce, but then also what they have in those bases. It's really important to consider that right now, especially where we've gone, you know, took that deep dive down under, you know, $4 or $3.90 level on that corn. There's some government support there, and you want to really do that in conjunction with your hedging and your other risk management, what you're doing to keep that all in balance. And we've spent a lot of time looking at that. We used that back in 2019, and so people have questions about that, give us a call, because we've built some spreadsheets on that to help people think about that and understand it. And The other deal is it's going to be an average price over the year. So it's not something like an old LDP days where you took the LDP and put it in the bank. You're going to have to work and think about this over the next marketing year, which just started basically on September 1st.
Very good. Well, once again, a reminder, folks, you are tuned into the weekly market roundup here on the Rural Radio Network, brought to you by Nebraska soybean farmers and their checkoff. Ross, I'm going to say take that same question to you. Some of those factors, the softer dollar, the jobs report. Do you see any of that influencing things on the livestock side of things?
It's tough right now to see that having a huge impact on cattle, just given the sheer fundamentals. But I mean, the fundamentals are bullish. We know that. That's why we've traded feeder cattle up to 370 this last week. That's why we've had fat cattle trading up to 245. So the thing where people got to be cautious is the market knows how bullish the fundamentals are. We've priced in the border being closed for more than likely the rest of the year. We've priced in 1 million less feeder cattle coming in from Mexico. We're pricing in no Brazilian beef imports. We're pricing in the tightest cow herd since the 50s. So I think the highs are in. I struggle. I think you can probably go make higher highs right now, but I think you got to be extremely cautious at these levels. And as Doug was talking about, manage your risk here, because at the end of the day, I think this rally's already far exceeded what any of us thought was possible. So I think you got to be mindful that when this thing feels like it runs out of gas, or I mean, it could be definitely a elevator down in a hurry, given the rally that we've seen. I mean, it's not common to see feeders rally 60 to 70 bucks in a 2-month span, and fats to put on 30 to 35. So, and you asked about the jobs number. There was a little bit of a miss there, and we've seen the equity markets pull back a little, and that is something that could eventually have an impact on these markets if we do continue to see some negative economic data that has more of an impact. I mean, there's no question that there's a correlation between the equity markets and the cattle markets that, goes back a long time in history. So, I mean, right now the stock market's been on fire, extremely strong, and it's coincided at the same time cattle have been rallying. But if we would see some more negative numbers, I mean, it certainly could have a little bit of an impact on cattle and take some of the steam out of this thing.
Yeah, very good. Well, folks, we've come nearly to the end of our time, so it's time for some closing thoughts as we wrap up this week's show. Ross, let's start with you. Let's just keep it right there. You talked about risk management. That continues to be just so critical going forward, doesn't it?
Correct. At these levels, I mean, we all know these aren't the new norm in cattle. I mean, $2.40 plus live cattle, and with where feeders are trading on the board, I mean, they've been above 360. We're taking a little bit of a breather there, but just continue to manage risk. I mean, just to be candid again, I mean, none of us know when this thing's going to top out. And I would say history tells you that no matter if it's corn, beans, or cattle, generally they top out when none of us expect it. So just be mindful of the downside that could happen in these markets. And, the other thing is none of us know what the next headline is going to be. It could be that they announce that the border reopens, and that would have a significant impact negatively on the cattle markets if something like that were to come out. So just be mindful, have some protection in place on these cattle.
And Doug, what, from your perspective with the grain guys, how should they be thinking about risk management?
We've been looking at their harvest potential yields and looking where we need to move corn or soybeans at harvest, and looking at basis levels where we're going to go with that. In the context of that, though, if you've got to sell a lot of corn and beans off a combine, I mentioned the ARC County and the PLC, you're going to have to work in context with that. If you sell all your corns and beans off a combine and we have a big rally, you could miss out on a PLC or ARC County payment and have sold your corn or beans here in the low area. You really have to be mindful of that this year. That payment is not guaranteed, so that's something you really want to think about and understand how those things are interacting. You have to manage the risk, like Ross saying, on the cattle as well. You'd want to think about that on the corn and beans, and not only about downside risk is what we're typically interested in, but now how's that mesh with the farm program?
Absolutely. Absolutely. Good thoughts there. Well, thanks so much to our guests this week, Doug Simon and Ross Baldwin. As a reminder, commodities futures involve substantial risk of loss, not suitable for all investors. That is this week's weekly market roundup, brought to you by Nebraska soybean farmers and their checkoff.